Welcome back to the Pro Ticker Podcast, your Monday morning edition covering major financial magazine headlines, everyone. Today, we're diving deep into the latest global economic signals and geopolitical crossroads, pulling directly from the September 15, 2025 headlines. Our mission here at the Deep Dive is to cut through the immense noise, unpack key market data points, geopolitical tensions, and some surprising shifts across different regions. We want to provide you with the essential insights to be truly well-informed without getting overwhelmed.
Yeah, it's certainly a rich set of sources we're looking at today. We've got a stack here from CNN, CNBC, Bloomberg, Reuters, Yahoo Finance. And what's really revealing, I think, is how these different reports, when you bring them together, they paint this multifaceted picture. You see these intertwined economic and political forces really shaping things right now.
Absolutely. And if there's one overarching theme that jumps out, it's this fascinating paradox. On one hand, you've got some markets, especially tech, just soaring to new heights. But then the underlying economic data and these kind of persistent global tensions, they're signaling a distinct note of caution. It's creating a really interesting, almost high-stakes balancing act for policymakers, for investors, and, well, for all of us trying to figure out where things are headed.
That's a perfect way to put it, a balancing act.
Okay, let's unpack this then. Let's start right here in the U.S. economy. We're seeing this striking contrast that almost feels, well, contradictory. The stock market's hovering near record highs. Sounds great, right? Pure optimism. But then the bond market. It's flashing some very clear signals of, let's say, fear about America's economic health. John Taufigi at CNN highlighted this. What's the bond market seeing that maybe the stock market's overlooking?
That is the crucial question, isn't it? And it really seems to come down to the labor market. We've seen some pretty significant signs of weakness there, which are, frankly, a major concern. For instance, CNN reported one of the biggest weekly jumps in jobless claims in over a year. That's notable. And then the August unemployment rate ticked up to 4.3%. That's its highest since back in 2021.
Wow, okay.
And if that wasn't enough, the Bureau of Labor Statistics data, also in that CNN piece, revealed a really stark revision. The U.S. economy actually added 911,000 fewer jobs for the year ending in March than they previously thought.
Nearly 1 million jobs just revised away.
Exactly. As Chip Huey over at Truist Advisory Services put it, I think this sums it up well. He said, the bond market is acknowledging that job creation, a powerful engine of the U.S. economy, is decelerating. That deceleration, that's the engine light flashing.
So yeah, stocks soaring, but bonds flashing fear.
It does feel counterintuitive. How has the bond market, often called the smarter money, how has it responded specifically to this shaky ground? Well, it's a classic flight to safety, really. It's a powerful signal. Investors, sensing this slowdown and looking for stability, they've poured money into U.S. treasuries. They're seen as about the safest assets around.
Right.
And this surge in demand, it pushed yields lower. The two-year Treasury yield, which is super sensitive to Fed rate expectations, so it's key, hit its lowest level since 2022.
Lowest since 2022.
And maybe even more significantly, the 10-year yield, that's the benchmark for everything from mortgages to corporate borrowing, it dropped to its lowest since April. It even briefly dipped below 4% on Thursday. It started the month around 4.27%.
That's a substantial move.
It is. And Kathy Jones at Charles Schwab, she noted this in CNN. She said, yields are coming down because the market is expecting slower growth ahead. She connected it directly to what the market thinks the Fed will do.
This really underlines that balancing act we mentioned. It really does.
Yeah.
The Fed's caught between, a softening labor market that seems to scream cut rates and this stubbornly high inflation that says, hold on. So with all these conflicting signals, weak jobs, but sticky inflation, what does this actually mean for the Fed's decision this week? Their meeting wraps up September 17th. And thinking about Esther George's warning on inflation, is there a real risk the market's getting ahead of itself on these rate cut expectations?
That's a crucial point, absolutely. Look, the expectation for a Fed rate cut is very high right now. Traders are pricing in something like a 96% chance the Fed cuts its benchmark rate by a quarter point this week. That's from CNN and Yahoo Finance. There's even a tiny 4% chance priced in for a half-point cut.
Wow, almost a certainty for a quarter point then, in the market's view.
Pretty much. Matthew Luzetti at Deutsche Bank, he even bumped up his forecast. He now expects 3 quarter-point cuts this year, September, October, December. But you're right to bring up Esther George, the former KC Fed president. She told Yahoo Finance she thinks inflation is kind of stalling out around 3%, and the underlying momentum still concerns her, even with the labor market softening. So it raises that question. Does the Fed really have the wiggle room to cut aggressively? Or do they risk just reigniting inflation if they do?
And then there's this unique wrinkle, right? The
Yeah.
political pressure. This
Yeah.
isn't just happening in an economic vacuum.
Not at all, no. As Bloomberg and Yahoo Finance have been reporting, President Trump has been very openly critical of Fed Chair Jerome Powell, calling him too late, expects a big cut this week.
Right, I saw those headlines.
Yeah, and he even tried to get White House economic advisor Stephen Mirren installed as a Fed governor right before this week's meeting. It really highlights this tension, this inherent conflict between the Fed needing independence and these very vocal political demands. It definitely complicates things.
It adds another layer of pressure on Powell.
For sure. The Fed is truly walking a tightrope.
Indeed. And that tightrope is made even more precarious by that persistent inflation number. The core CPI, stripping out food and energy, it rose 3.1% year over year in August. That's still well above the Fed's 2% target, as we saw in reports from CNN and CNBC.
Exactly.
So you've got the weakening labor market demanding a cut, but inflation stubbornly refusing to play ball, plus the political heat. It's an incredibly complex situation for them.
It really is. And this intricate dance between U.S. data and Fed expectations, it obviously creates ripples globally. And as we shift focus now, we see those ripples playing out very differently across continents.
Okay, so where should we look first? Let's start where the markets seem to be ignoring all this caution. The tech sector. That seems to be flying.
It truly has been an incredible run, yeah. CNBC's Daily Open called it a perfect week for the NASDAQ composite. 5 straight days of all-time closing highs. It gained 2% for the week.
5 days straight. Wow.
Yeah, significantly outperforming the S&P 500, which is up 1.6%, and the Dow up only 1%. And the driving force, it's undeniable. Artificial intelligence, AI. OpenAI seems to be behind a lot of this market buzz. Oracle shares soared because of a deal with an AI firm. Companies like Broadcom and NVIDIA, they've had huge lists before related to AI.
So AI is really the engine here.
Absolutely. And a Fed rate cut this week, as CNBC mentioned, that would be particularly good news for these growth-focused tech companies. Think about startups like OpenAI, often burning cash, maybe carrying debt. Lower rates make it easier for them to get capital and keep expanding.
That makes sense. Easier money fuels growth, especially in tech. But, how sustainable is this AI rally if the underlying economy is showing cracks like the bond market suggests? And how does that contrast with what's happening across the pond in Europe?
That's the million-dollar question on sustainability, isn't it? And the contrast with Europe. Well, couldn't be much starker. Europe's market, especially for IPOs, initial public offerings, it's really lagging. Badly. FactSet data cited by CNBC shows North American IPOs have raised about $17.7 billion this year. Europe, just $5.5 billion.
That's a huge gap. Why?
Well, it's a few things, according to analysts. A perceived lack of sort of quality companies ready for the public markets, a lengthy IPO process in Europe that makes deals vulnerable to market swings, and, regulatory fragmentation across different countries. Plus, these big capital-intensive industries like AI or the energy transition, they often just look to the U.S. markets to raise the massive amounts of capital they need. Take Klarna, the big Swedish fintech. They chose to list in New York. That sends a pretty strong signal.
Yeah, that does. And any specific countries struggling more than others in Europe?
Well, France, in particular, is facing some significant headwinds. Fitch actually downgraded their credit rating from AA down to A+. Yeah. Citing a high and rising debt ratio and political fragmentation that's making it hard to get their fiscal house in order. That's according to CNBC. Their borrowing costs have gone up, and Moody's and S&P might issue downgrades soon, too. So definitely a tougher picture in Europe.
Okay, so tech booming in the U.S., Europe struggling. What about Asia? Are there any brighter spots amidst these mixed signals? It gives us a more nuanced global picture, maybe.
There are actually a couple of interesting positive movements. As CNBC reported, South Korea's Kospi index, their main stock index, hit a record high. It logged its 10th straight session of gains.
10th straight. What drove that?
Apparently, the government scrapped a plan to raise taxes on stock investments, and the market really liked that.
Okay, policy matters.
Definitely. And China's CSI 300 index also managed to advance. This was despite some recent data showing a deepening economic slowdown in August. Retail sales, industrial output, investment all missed expectations, as CNBC detailed.
So the market looked past the weak data.
It seems so, at least for now. It suggests a complex dynamic where market sentiment can react well to policy moves or maybe just temporarily look past some economic softness.
Right. And speaking of China, their relationship with the U.S. heat, That continues to be a huge global story.
Hmm.
High-stakes trade talks are happening right now in Madrid, adding another layer to this whole global economic dance.
Indeed, they are. Officials from both sides are in their second day of talks in Madrid. They're covering the trade partnership, those divestment plans for TikTok, and just broader economic and national security stuff. According to CNBC and Reuters, this is the fourth round of these bilateral meetings in just 4 months. It follows that agreement back in May to kind of pause most of the really steep
The
tariffs.
fourth round in 4 months. Sounds
It
serious.
suggests they're trying to keep the dialogue going, at least. But these aren't just about tariffs anymore. They're about global strategic positioning, really.
And a really critical point of contention, one that gets a lot of headlines, is TikTok. Its fate seems to be hanging in the balance. That's a real geopolitical headache, isn't it?
It absolutely is. ByteDance, TikTok's parent company, they're facing a Wednesday deadline. They need an agreement to make sure the app keeps running in the U.S. U.S. Treasury Secretary Scott Bessent put it pretty bluntly, as reported by CNBC. He said the U.S. is not willing to sacrifice national security for a social media app.
Strong words. But what's China's position? They have to approve any sale.
Right, exactly. And China has put the technology itself on an export control list. That makes a simple divestiture way more complicated. President Trump, according to Bloomberg and CNBC, told reporters that TikTok's fate is basically up to China.
So it's moved way beyond a business deal into a real test of wills between the two countries.
Completely. It's pure geopolitics now.
And then there was that surprising news about NVIDIA. That just adds another layer to these tech and trade tensions. This wasn't just some standard regulatory decision, was it?
No, I don't think so. This is a significant development, reported by both Bloomberg and CNBC. China ruled that NVIDIA violated anti-monopoly laws with its acquisition of Mellanox Technologies back in 2020. This was based on a preliminary investigation. NVIDIA shares dipped about 2% on the news.
So why now? That deal was years ago.
Right. And many observers, like George Chen of the Asia Group, quoted by CNBC, see this as clearly part of negotiation tactics run by Beijing, basically showing Washington they can play tough.
Using regulatory tools as leverage in the broader talks.
Seems likely. And it fits a pattern. It comes alongside China's anti-dumping probe into some U.S. semiconductors, and they're also scrutinizing U.S. restrictions on China's own chip industry for alleged discrimination.
So technology and trade are now just deeply, deeply intertwined with geopolitical strategy. They're a primary battleground.
Couldn't said it better myself.
Yes. Okay, wow. As if the economic and trade headlines weren't enough drama, we also have big developments in the global energy landscape, especially impacting oil markets recently. It feels like every corner of the global economy is under some kind of pressure right now.
That certainly seems to be the case. And what's fascinating here is how quickly markets react to geopolitical events. Oil prices edged higher, according to Reuters, specifically because of Ukrainian drone attacks on Russian energy
A
facilities.
bunch of facilities were hit.
They hit the Primorsk oil exporting terminal. That thing has a capacity of around 1 million barrels a day, and also the Kirishi refinery.
1 million barrels a day capacity.
Yeah.
That's significant.
It is. And JP Morgan analysts noted that these attacks, quote, suggest a growing willingness to disrupt international oil markets, which has the potential to add upside pressure on oil prices. It's just a stark reminder of how vulnerable global energy supply chains can be.
And interestingly, U.S. foreign policy is also playing a role here, right?
Yeah.
Adding another layer to the energy discussion and tying back to that big theme of everything being connected.
Indeed. President Trump stated, this was reported by Reuters, that the U.S. is prepared to impose fresh energy sanctions on Russia. But there's a condition: only if all NATO nations stop buying Russian oil and put similar measures in place themselves.
So it's a conditional threat, adding a diplomatic angle to the energy market volatility.
Exactly. It underscores the complex political calculations that go into global energy supply and pricing.
Okay, moving from the immediate oil market shifts to something more forward-looking.
Yeah.
The U.S. and U.K. forging a new, pretty ambitious energy partnership. Feels like a strategic move.
It definitely looks like a long-term strategic play focused on energy security and future tech needs. This is a significant development for the future of energy, highlighted by CNBC. During President Trump's state visit to the UK this week, the US and UK are apparently set to sign major deals. They're aiming to kickstart what they're calling a golden age of nuclear power.
A golden age of nuclear. What does that involve specifically?
Well, the plans include building up to 12 advanced new modular reactors, SMRs, in northeast England, and also developing data centers that would be powered by these SMRs in Nottinghamshire.
Data centers powered by small nuclear reactors.
Yeah.
That's futuristic.
It is, and it tackles two problems at once: energy supply and the huge power demands of AI. U.S. Secretary of Energy Chris Wright called it a true nuclear renaissance. The goal is thousands of jobs, billions in private investment, especially to fuel those energy-hungry data centers for the AI revolution.
A clear strategic move then, addressing energy independence and the demands of new tech.
Precisely.
Okay, we've covered a lot of ground. The Fed's dilemma, tech surge versus Europe's lag, U.S.-China tensions boiling over TikTok and chips, energy volatility, new nuclear ambitions. So, stepping back from all these headlines, what truly stands out to you from this deep dive? It's a complex landscape.
I think the core insight here is this. Despite the kind of surface-level enthusiasm in parts of the stock market, bond investors are signaling a really deep-seated fear about slowing growth. And that's pushing the Fed into what could be a politically charged rate cut cycle, which might just dictate market dynamics for months to come.
Right, the bond market is the canary in the coal mine.
Kind of. And at the same time, we just see the profound impact of geopolitics everywhere. Every trade negotiation, every energy strike, every regulatory decision on tech, it's all interwoven now with national security and this global race for technological dominance. It's this constant dance between economic data, market sentiment, and, well, political maneuvering.
A very intricate dance indeed. So, as we look ahead to the Fed's decision this week and these ongoing global negotiations, here's a provocative thought to leave you with. In a world driven increasingly by both incredible technological advancement and hard-nosed geopolitical realpolitics, how will this delicate balance between national security, economic growth, and market stability ultimately shape the investment landscape for the next few years? What trade-offs will define our global future? We'll see you all tomorrow morning with new headlines from major financial magazines.